Hello and good morning friends, welcome to CEC live lectures. Dear friends, once again we welcome you with our ongoing series on financial accounting. Today under this series we are going to talk on introduction to Ind AS. Now you might be wondering what we are going to talk. Dear friends, we would like to tell you all that we are going to give you a very vivacious session on today's topic, as we have with us for the discussion Dr. Amarjeet Kaur. Dr. Amarjeet Kaur is a professor of accounting and she is teaching in one of the leading institutions in the country. She is a certified management accountant and she has authored number of books on accounting. Number of her articles have been published in reputed journals at national and international level. She is a visiting faculty in various colleges and universities both in India and abroad, and she is appreciated by the students nationwide as well as in the world too. So friends, if you want to ask questions from Dr. Amarjeet Kaur on today's topic, that is introduction to Ind AS, then you can call us through our toll-free number. Our number is 1-800-110-430. I repeat, our number is 1-800-110-430. You are requested to call in the last 10 minutes of the lecture so that first you get in-depth knowledge on today's topic, and afterwards we promise to give answers to your questions through Dr. Amarjeet Kaur, who has immense experience. So let's take advantages through her experiences and let's try to grab maximum knowledge through her. Hello ma'am, welcome to the lecture.
Hello Kirtika, thank you very much. Very good morning to viewers and welcome on yet another lecture in financial accounting. Topic, as Geetika just introduced, is Indian accounting standard, which we call as Ind AS. So this is an introductory session on Ind AS. We will cover Indian accounting standards existing as well as the previous one, the old one. Try to understand major comparison or differences between the two, and we'll also talk about international financial reporting standards, their difference from Ind AS, and lastly we will cover few important Ind AS as been introduced recently. So this would be the agenda for today in 1 hour. So let's think that how the businesses are changing now. The businesses are changing, very furiously because of the globalization, because of the competition, not from within the boundaries but from outside as well. Businesses have to respond to those changes, to those either they are economical or technological or political. All kind of changes are happening very fast, very fluidly. So the point is, do we have enough information in our financial statement which could be useful to the people who are sitting overseas, who are sitting in the rest of the part of the world? So we intend to produce such financial statements which could be useful not only to the users sitting in the country itself but sitting overseas as well. So we want to bring comparability in the financial statement at world level, not at nation level. So comparability in the financial statements is essential. It is required because of the globalization, because of the nature of the business is changing. The way we used to operate has changed absolutely. We all are operating online. We have such a fast system of information. The flow of information has been turning out so fast every single day. So the point is, the way we used to report, or the accounting standards which were helping us to report in the past, are they enough or are they sufficient even in the changing scenario or not? Of course they are not. There is no option then to change our standards to international level, so that whatever we produce in the form of our financial statement, they are comparable, they have the consistency, and they are useful at international level to the global user, either the investors or or the shareholders or the bankers, whosoever, right? So adopting or bringing Ind AS was not a choice to my understanding. It was a matter of compulsion. It was the need of the hour. This is what I would say, right? So accordingly, in India, the government of India through Ministry of Commerce, External Affairs, so Corporate Affairs, sorry, so MCA, Ministry of Corporate Affairs, they have announced, new accounting standards in the Rule 2015 under the Companies Act 2013. So Ministry of Corporate Affairs, of course, the standards were prepared by Institute of Chartered Accountants of India, and they were circulated through a notification by Ministry of Corporate Affairs under the Rule 2015 or 2015. Right? This is the background legally. So far, ICAI have introduced 39 Ind AS, Indian Accounting Standards, which are precise, and a roadmap to adopt Ind AS, which is Indian Accounting Standards, have also been issued in February 2015, that who all are supposed to adopt Ind AS. So a guideline, a detailed guideline has been prepared, notified by the ministry. It is available. So as per the guideline or the roadmap, from 2016, the financial year 2016 and 17 onward, all companies which were listed or unlisted but having net worth of more than 500 crores were required to adopt Ind AS. So the adoption of Ind AS by the companies having net worth of more than 500 or 500 crore or more than 500 crores. So they were supposed to adopt Ind AS. So this was in the year 2016-17. Now beginning from the financial year 17-18, we are currently in the financial year 17-18, of course. We are in November, this is November 8th today, and financial year of course begins in India from 1st April. So 1st April 2017 to 31st March 2018, now all listed companies are required to report based on Ind AS. This is one, plus all unlisted companies having net worth of more than or equal to 250 crores rupees are required to adopt Ind AS and report based on Ind AS. It means, in the last year, in 2016-17, the financial year 2016-17, the slab, this cap was 500 crores, right? 2016. Now the cap has been reduced down to 250 crores. So if one company is a listed company, right, irrespective of their net worth, company is required to report through Ind AS or by applying or using Ind AS from this year onwards. So the next year would be very, very important for Indian economy, for people like us who are into accounting profession, because we are going to witness the first time full reporting of Indian companies based on Ind AS. And this year, I am a trainer also, a corporate trainer, so I have seen a high demand coming from the corporates to train their employees on Ind AS, how to use Indian accounting standards, right? So because they are working, this is the first time when all listed companies, irrespective of their net worth, are required to adopt and report based on Ind AS, right? But this 250 crore, so condition, the roadmap, the third guideline is this: in future, in any case, in any company becomes, or the net worth becomes more than 250 crore. So either a listed, of course, unlisted company, because listed companies are covered this year itself. So any unlisted company, if its net worth becomes 250 crore or more than that, the company is required to adopt it in future, right? Banking and insurance companies have been excluded for the time being. So this is the roadmap. You can have a look here to understand how this roadmap looks like. So this slide is there in front of you. Kindly have a look. This slide says you know, the same, it has the same description as I just said, that the Ministry of Corporate Affairs, MCA, has introduced the roadmap in 2015. It was introduced on 16th of February, and I have shown you the 4 categories or 4 slabs as discussed. 2016-17 meant for listed and unlisted companies having net worth of more than 500 crores or equal to 500 crores. 2017-18, all listed companies are supposed to, this last line in this block if you refer, and unlisted companies having net worth of equal to or greater than 250 crore. And in future 18-19 onwards, whenever a company's net worth becomes greater than 250 crores, the company is supposed to follow this Ind AS. Now the question comes in, what would and how would we calculate net worth? This is the point. Once we have seen this slide, you know, and have discussed that a company will fall to adopt Ind AS and as per the given roadmap. But the question is how to calculate net worth for the purpose of seeing whether a company is required to adopt Ind AS or not, right? So, for this purpose, what do? We apply a rule where we take share capital, we add up all the reserves and surpluses which are created out of profits, and then we add up them. So, paid up share capital, all reserves, and also the securities premium. So, it means if I have issued share capital on premium, so I must have the premium account, the security premiums account with me. So, that also belongs to shareholders, of course. So, share capital plus reserves and surpluses created out of profits, and then the third thing is the securities premium account. So, the sum of these 3 is taken to calculate the value of the net worth. From this value, we are supposed to subtract any deferred expenditure, any accumulated loss to find out the net worth. So, the net worth is calculated basically by adding those 3 elements I said and subtracting deferred expenditure as well as accumulated losses. So, this is the calculation of net worth for the purpose of assessing a company falls under Ind AS rule or not. Okay. So, let us move forward and let us see what will happen, you know, when there are overseas subsidiaries. So, if we have Indian companies and the holding company is an Indian and subsidiaries are also an Indian company, then they all are supposed to follow, you know, both the companies are supposed to follow Ind AS, right? Both consolidation and standalone financial statements should be prepared based on the Ind AS. But the second situation, when the holding company is Indian, right, and the associate or subsidiaries or joint ventures are overseas, then what would happen? So, those overseas subsidiaries would be required to follow the local country's rule wherever they are working. If some company is based in US, they would follow the accounting standards of US. If some company is based in UK, they will follow the accounting standards as applicable in UK. But the point I am making it out is here, after they have prepared their statements as per the local laws or local accounting standards, thereafter the subsidiary company is required to adjust their financial statements, and finally the consolidation will happen by the Indian company in the country itself. So, adjusted statements as per Ind AS is the requirement if the parent company is an Indian company. But if other way around, the parent company is an overseas company, right? So, some company which is based in Switzerland, based in UK or based in US, and they have their subsidiaries in India. Now, the question is, what will happen in that case? So, in that case, the companies which are working in India and are subsidiaries or joint ventures to an overseas parent holding, So they would require to follow Ind AS because they are working here. So it's very much like as it is applicable for Indian subsidiaries. So Indian subsidiaries working overseas are required to comply the accounting standards of that company and adjust their statements for consolidation in India. And so is the company if it is a subsidiary of a overseas parent company, then subsidiary or joint venture company would require to follow the standards of India, which is Ind AS, and then the company or their country may require them to adjust their financial statements as per their accounting standard in the parent in the country where the parent company is registered, right? So this is how we consolidate and which all companies fall under adoption. Now moving forward, let's discuss difference between Ind AS versus the existing Indian GAAPs. Of course, I am not covering the complete set of differences, but certainly I am going to cover few important points. The first point is this, that in the substance and the legal form, that Ind AS is based on substance rather than legal form. What does it mean? So it means that in case, let's take some example. Ind AS emphasizes on substance, not on the legal form. We call it as a form only. Let's say that one building has been sold by A to B. So building has been sold legally. Ownership, a sale deed had happened. Ownership right has been given. The papers have been given to B. But when it comes to using the building, it is still in the occupancy by A, right? All the benefits of the building, because of the ownership, are actually drawn by A only. So legally it will seem B is owner because A has already sold it. But the associated benefit of buying the building are actually not transferred. A has not actually vacated the building is still with A. So in this case, we will not take that building has been sold, or we will not register sales in the books of A. So this is what is substance, because we have to look at what is more substantial, what is more important here. It's not the legal form is always very, very important. So in our old GAAP, which we call that Indian GAAPs, generally accepted accounting principles, which are still applicable for all other business houses then upon which the roadmap is applicable for Ind AS, right? So all other business units are still using Indian GAAPs. So they may use that particular set which says is fine, which was more towards, more inclined towards legal form, whereas this Ind AS is more inclined towards substance. Then the another difference is basically between the consolidation. How do we assess consolidation, or under which condition the consolidation will take place? Earlier in Indian GAAPs, so we were concentrating on the ownership in the capital, right? But now the Ind AS says it is the right or to share the revenue, or how much right you have over the revenue or losses. So it is basically talking about the recurring income instead of your ownership in the capital. So this is the basis to find out consolidation now. It means if we will look at that how much or profit sharing is there between the companies to decide who will consolidate. So to prepare the consolidated reports, basis is no more the share in capital, rather it is share in recurring revenue or in losses, the recurring income, the recurring loss part. Then Indian GAAPs, of course, were of good in those times, but Ind AS is more inclined toward to present a very true and fair value. So this is another feature. So this has been brought in purposefully, consciously in Ind AS. Moving forward, the Ind AS here, instruments which, financial instruments, debt and equity, how they are accounted is different. In Ind AS, if there is a convertible debt issued, then it means the convertible debt means it can be converted into equity, so it would be taken as a part of equity as per Ind AS, whereas as per the Indian GAAPs that was taken as a debt equity. Now it makes a lot of difference. It really makes a difference in the quantum of reporting, the reported earnings, the debt covenants, and the calculation of net worth even, right? So this is another very important difference between the two accounting standards. Then another important thing is, if you look at the third point on the slide in front of you, we have increased use of fair value driven accounting in Ind AS. Earlier, fair value use was not emphasized upon under Indian GAAPs, but in Ind AS we are, in most of the cases it is it's a very strong emphasis to use Ind AS then to use fair value than the cost price or any other basis. So this is important difference. Then moving forward, the quantum of disclosures under Ind AS has gone up. It is significantly, noticeably significantly improved actually. The quantum, the how much we report, right? This because there is a requirement that notes are considered, part of the statements. There are requirements to share estimates, all kind of details in the notes. So the quantum of reporting has improved under Ind AS. Moving forward, another requirement is this, that Ind AS requires there should be uniform accounting policies between the subsidiaries and the parent company. So consolidation happens. So for the purpose of better reporting and better consolidated results, fair results, it is required that the parent and the subsidiary or joint venture companies, they would use the same accounting set of policies. So this is another important difference. When dividends are announced in and approved in shareholders meeting, in general meeting of shareholders for a company, so in that particular year only the dividend would be identified and measured. So it would be recorded in the year when the dividend has been approved in general meeting of shareholders. So this is another change, not in the year of payment, but rather the year when the dividend amount has been approved. Okay. So these were the few important differences between Ind AS and Indian GAAP. So next question is convergence with IFRS, which is International Financial Reporting Standards. So once we decided to adopt Ind AS, the question was, because the purpose was to bring comparability at world level. That is the major option. Of course, there are many more objectives in mind. Now the question was, should we be adopting international financial reporting standards as it is, or should we be converging? So that was a very big question in hand. So what has been decided by the ministry and ICAI in this regard is that we decided to converge, then to adopt IFRS as it is. It means we planned out few carves outs, few changes, few variations from IFRS, so that the standards which we bring in, the Ind AS I am referring here, which we bring in, they are actually relevant to the Indian practices, Indian business practices, if to be precise. So this was this would be the focus in mind in adopting and planning out Ind AS. So how we are doing it? By making a carves out from IFRS. So basically, more or less, our Ind AS they are very much equal, or they are very much alike IFRS, but not 100% alike. So they are close to, rather I would say, they are close to IFRS, but not very alike of IFRS. Moving forward, let's find out the difference between IFRS and Ind AS. So I hope you understood. Earlier we discussed the difference between the existing Indian gaps and Ind AS, the major points. Now I am talking about the major point of differences between IFRS and Ind AS. First of all, the terminology used between the two is different. So there are a couple of, for example, we are sticking to the word balance sheet, whereas in IFRS it could be a statement of financial position. This is one difference. Then the another difference is that the comprehensive income, the other comprehensive income needed to be the part of statement of income and statement of profit and loss, whereas in IFRS this is the option in the hand of the business entity to decide to make a statement of comprehensive income as part of the profit and loss count, which we say statement of profit and loss, or to show it separately as a separate statement. But Indian accounting standards, Ind AS, they do not allow business entities in India to show comprehensive income as a separate statement. It needed to be the part of statement of profit and loss only, right? Then another important point is that the classification of expenses for the purpose of statement of income and loss, profit and loss. For the purpose of statement of profit and loss, the expenses were earlier, there was a matter of choice. They were classified based on function. So even in Indian gaps, the expenses were classified in the statement of profit and loss based on the function only. But IFRS allows to use both of them, either based on nature and functional, whereas the Ind AS doesn't allow to use the functional classification. It requires a business to use only the expense classification which is presented based on nature. So this is another important difference. Then earning per share. Know how to present. If there are two businesses, consolidation and the standalone, two businesses reporting separately, of course. So Ind AS requires that EPS should be disclosed separately for the standalone business as well as for the consolidating business. So it is required, whereas your IFRS doesn't require. So they require that only EPS for the consolidated results could be shown. It means our Ind AS are requiring more disclosures, better disclosure than IFRS on these points at least which I am discussing, right? So moving forward, the purchase gain or loss, which is known as goodwill. So if I purchased a business, we acquired a business, right? And we gained something, or we may lose. So we call it as bargain loss. So in purchase, so if we have a bargain loss or bargain gain, which is goodwill, so goodwill should be reported in both the conditions, IFRS as well as Ind AS. But under Ind AS, the bargain purchase gain can be recognized either in the comprehensive income or under the capital reserve. There is a choice, right? But not in profit and loss account, not in the statement of profit or loss. This is a very important difference between IFRS and Ind AS. IFRS allows you to record the gain, the bargain, the gain in bargaining, which is we call as goodwill, the value of purchased goodwill in your profits for that year, which is actually not allowed in Indian gaps as well as in Ind AS. This is another important difference between International Financial Reporting Standards and Ind AS. So I hope you were able to understand these differences. We will pursue with few standards in the next half. Thank you very much for watching. Thank you. Very good afternoon to you all and welcome back in the second half where we are going to talk about few Ind AS specific standards, whatever we could cover. I would try to cover at least 3 of them, important ones. So we are beginning with Ind AS 101. So because they have been numbered, right? So it's important to remember number. The first standard I am going to cover is Ind AS 101. So what is this? This standard is basically first time adoption of Ind AS. So an entity which is moving from Indian GAAP to Ind AS, they need to apply the requirements of Ind AS 101, right? So this 101 requires full retrospective application of Ind AS. So barring few exceptions, the standards requires that whatever, if we are adopting, if we are required to adopt or we are adopting by choice. So if we are supposed to adopt Ind AS, we should be applying them retrospectively and on all the items of the financial statements with no exception from our side, unless there are certain exemptions or exceptions which are mandatory, right? So this is what has been said in Ind AS. So one important difference, in Ind AS and IFRS is this, that Ind AS, and especially this has been mentioned in 101, it allows us to report PPE, the property, plant and equipment, the value of PPE at the price, which at the cost price which has been there as per Indian GAAPs. So we can borrow the value from Indian GAAP as it is, we need not to show on the fair value. So this is one important aspect while we are adopting it for the first time. So otherwise we have to apply it retrospectively and on all the items without exception. This is 101. Unlike IFRS, in IFRS what happens, for every individual standard there is a, in that standard itself there are guidelines how to adopt or how to switch, right? But in Indian GAAP, Indian accounting standards, Ind AS, we do not have such provision. We have rather a different provision. Our provision is that we have altogether introduced a new standard, which is Ind AS 101, which I just mentioned, just to help us dealing with adoption, that or how to change, how to switch from Indian GAAP to Ind AS. Right? This is entirely different from IFRS adoption. Moving forward, let's talk about what all comprises in financial statements under Ind AS. So, complete set of financial statements under Ind AS comprises balance sheet at the end of the period, statement of profit and loss for the period, statement of changes in equity for the period, statement of cash flow for the period, then notes comprising a summary of significant accounting policies and any explanation required. So, this is important, that is why I have marked it in red. Then we need comparative financial information in respect of preceding year as specified. So, it means we need to show the balance sheet of 2 years, that is the point here, and also we need to show the profit and or income statement or statement of profit and loss for 2 consecutive years. So, this is the requirement under Ind AS. So, the list was comprehensive one. It was showing you all set of statements required as per Ind AS. So, if you look at the if you have noticed, it is important to note down that notes also forms a part of financial statements. Notes are no more ignored now because we need to mention accounting policies and our explanation that why did we make any particular estimate in a particular way. The estimates about the life of the assets, estimates about the salvage or a saleable value of an asset after its useful life, they all are the basis for calculation of depreciation, for example, right? So, they are supposed to be there mentioned very well clearly in the notes, and notes form part of financial statements, right? So, next standard I would like to talk about is Ind AS 1. So, what is the purpose of, so most of the standards they have shown their scope, their purpose, objective, everything in the standards. So, Ind AS which is about the purpose of financial statements, it says the general purpose financial statement should give information about 3 things. One, about the performance, second, about the position of the company, that is financial position, and third is cash flow. It means company must prepare the statement of income or profit and loss, statement of financial position, which is balance sheet, and the cash flow. So, cash flow statement becomes essential now. Earlier it was not mandatory for all the businesses to prepare cash flow, there were certain clause. Now the cash flow, preparation of cash flow statement is mandatory for all those companies which are required to follow Ind AS. This is an important development in India, because earlier I used to discuss that cash flow preparation is mandatory in US but not in India. For all companies it is not required, but now after Ind AS came into existence, it is required for all those companies which are required to adopt Ind AS to prepare cash flow statement. Okay. Now, basis of presentation of financial statements as per AS 1, Ind AS 1. So, the first 2 statements on the slide in front of you are going concern basis and accrual basis. So, they are basically essential requirements. They form the most important assumptions, underlying assumptions in accounting standards as Ind AS, as per Ind AS 1. Then thereafter, as I just said few minutes ago only, that now the reporting is more substance based than the legal base, so that becomes the basis. Fair value is another important thing. Most of the items are required to be reported on fair value. Our presentation is more disclosure based now than the previous records, materiality based, and then the expenses are nature based. So these are the bases that how the financial statements would be presented. So the bases have certainly changed in three important aspects rather. One, the substance over form. The second is fair value over the cost or market price. And the third is your expenses, which is now based on nature, not based on function. Going concern accrual remains important as it was in the past as well, right? So moving forward, let's have a look and discuss what all do we need to have, what are the requirement or essential information required in balance sheet. If you look at the slide here, we require assets to be shown under the heading property, plant and equipment, PPE, which is at par with IFRS. So earlier we used to show fixed assets, now we are supposed to show PPE, and under that we may have intangible and tangible assets, right? So, or fixed assets. Then we need to show investment property separately, intangible assets separately, any financial asset, right, that needed to be shown separately. Biological assets should be separately shown. Deferred tax assets, current tax assets, they needed to be shown separately. Inventories, trade and other receivables should be one heading in the balance sheet. Cash and its equivalent should be another heading, and assets which are held for sale, they should be classified separately, and assets which are held for disposal should be shown separately. So these are the requirements as per Ind AS. What are the requirements for the purpose of statement of profit and loss? The one important change, as I mentioned twice I believe so far, is that the expenses now should be shown based on nature, not based on function. This is the first requirement. But any item which is important, which is material, should be reported as a part of statement of profit and loss. So additional line items or subheadings are presented in this statement when relevant to understanding of entity's financial performance. So this is a generic statement but is very broad basically, because this clearly shows that if a business consider that a particular item is important to depict the financial performance, then it should form a separate line item, it should be a separate subheading, right? Then no item of income or expense is presented as extraordinary item. This is another important point. So third important point. First, as I said, the expenses are to be expressed on nature based. Second is what all items to be shown separately in additional line item or subheading. And the third is no item to be shown as extraordinary item as it was there in the past. So even in the past, when we used to prepare cash flow statement, we used to adjust extraordinary item to start preparing a cash flow statement, which is no more true. Now we adjust only the profits with taxation, not with extraordinary item. So no item to be shown as extraordinary item in income statement. This is as per the Ind AS. Then if we see at the material items, there's another important aspect of new standards. It says the nature and the amount of items of income and expenses are disclosed separately where they are material. So now business has to decide what is material for reporting purposes. What would be more material to be informed or to be shared with the users of financial information. So this is there. Then that disclosure should be either as a part of the statement, financial statement, or as a part of notes. So this could be anywhere. So it's not essential that it should be either in balance sheet or income statement, it could be in notes as well, right? And then such income and expenses which are immaterial, they should be included either restructuring costs, write down of inventories, property, plant and equipment. If we are writing down any of them, inventory or property, so they become important, they become material, they should be informed either in the financial statement, primary statements or in the notes. Okay. Then that what all comprises in other income. In other income, which is other comprehensive income, that is grouped into that should be reclassified subsequently to profit and loss, or those that will not be classified. So we need to have two groups, one for those incomes which are going to be reclassified and another for those incomes which are not going to be reclassified. So this is essential requirement in comprehensive income, the statement of comprehensive income. Then another thing is that this reclassification adjustment, if been made, this should be disclosed. That's another requirement. Then the next statement, as I showed you the list of the financial statements as per Ind AS, the next statement is your statement of changes in equity. The statement of changes in equity, if you look at the slide here, it shows the total comprehensive income for the period, showing separately the total amount attributable to the parents, owners and non-controlling interest. So we have controlling interest and non-controlling interest. We need to show the comprehensive income should have these two heads separately. Then also for each component of the equity, the effect of retrospective application or restatement recognized in accordance with the Indian Accounting Standard 8 should be reported. This is another requirement to be met in preparing of statement of changes in equity. And the last thing is that amount of dividend recognized as distributions to owners during the period and related amount of dividend per share shall be disclosed. It should be disclosed. So whatever the amount of dividend per share we are going to distribute, it should be disclosed in the comprehensive income, the statement of changes in equity, right? Now, as I said, statement of cash flow is also important part of now the financial statements, which was not true earlier. Earlier it was subject to certain conditions, only under few certain conditions which were primarily towards turnover, that a company was required to prepare cash flow statement. But now a business is required to prepare cash flow statement if it is required to adopt Ind AS. So the moment a business, so as per though this is a part of financial statement, but interestingly and importantly, we have a separate Ind AS, which is Ind AS 7 for preparation of cash flow statement. Though I am discussing this cash flow statement as a part of financial statements, but nevertheless we are automatically covering few important characteristics or features of Ind AS 7. So as per Ind AS 7, the cash flow statement is prepared, and we do not consider for the purpose of preparation of cash flow statement, we do not consider extraordinary item anymore, which we used to do as per Indian GAAPs earlier. Thereafter, all activities happening in business needed to be divided under three groups. The first group is operating activities, the second group is investing activities, and the third group is financing activities. So it means we need to segregate all the business transaction as per this classification, and this is how it used to be in the past as well. Here there is no difference, and then to report, right? So a separate disclosure is made of significant non-cash transactions as well, other than these three items, three categories: operating, investing and financing. A business who is preparing cash flow statement as per Ind AS 7 is required to also disclose separately if there is any non-cash transaction but is significant. So what could be a non-cash transaction but significant? For example, my share capital as per my balance sheet is showing increase. So share capital was 1 crore last year, now it is 1.5 crore. There is a issue of share capital by 50 lakhs. So the point is this Ind AS requires the information, if it is of non-cash nature, to be shown separately at the bottom of the cash flow statement. So if the share capital was issued by issuing shares against cash, then certainly it would go in the cash flow statement with under your last section, financing. But if the same share capital was issued by redeeming debentures or by converting preferential capital or by converting debentures, then certainly I do not have any inflow of cash. My share capital has gone up, but this is a non-cash transaction, but is a very, very significant transaction. I cannot ignore this transaction because my books are showing an increase in my share capital, right? So this particular example is a very good example to understand that what are non-cash but significant items or transactions. So issue of share capital by redeeming debentures is a non-cash yet a significant transaction to be reported under the cash flow statement, outside the cash flow statement, right? So as I said, notes also form part of financial statements as per in Indian Ind AS. So how should we be presenting notes? So important part is this, that notes are now integral part of financial statements, and they should, if you look at the words which are marked in red color, notes include accounting policies, critical accounting estimates and judgments. So this is important that we show all notes carefully, and especially pertaining to the accounting policies, the critical accounting estimates, rather they are about the stock, about or revaluation, or they are about depreciation or life of the asset to be depreciated, or the scrap value of a fixed asset. All those are important estimates, and this requirement is very much there in Ind AS, that these should be disclosed very carefully and truly in notes under Ind AS. Okay, so moving forward, now I would talk about another standard. Maybe this would be the only standard we would be able to cover in next 4-5 minutes. So that is in Ind AS 18, which refers to revenue. So Ind AS 18 is precisely pertaining to revenue, how to recognize, when to recognize revenue. So this is what this standard covers. So revenue is gross inflow. As per Ind AS, it says revenue is gross inflow of economic benefits during the period, right? And next question is, primary question is, when to recognize revenue. So exception is also mentioned as per Ind AS. Ind AS says that taxes which are collected or revenue which is collected on behalf of any agency relationship. I am an agent of X company, I collected revenue, I collected tax, right? So that is not my revenue, that is an exception. Though economic inflow is there, cash is coming in. Most of the businesses in India are required to collect TDS, tax deducted at source, to subtract tax and keep it with them, and to submit it with the government of India, with the taxation, so with the income tax authority. So this is so they have been actually designated as agents, businesses as agents of income tax authorities to collect tax on behalf of income tax authority, right? So that doesn't become the revenue of the collecting business. So if if X person is working in a university or in a business, any office, and his employer is subtracting a tax from his salary and keeping it with them, and then paying to the income tax authority, that tax collected on behalf of individual for the income tax authority doesn't become the revenue. So this is a very simple thing to understand, right? So moving forward, how do we measure revenue? That is the question. So first of all, the scope of this Ind AS is for three things: sale of goods, services rendering, and then third is the use of other assets which are yielding in interest generation, royalty generation, dividend generation. So they are also the revenue, though they are other revenue. So this standard deals with sale of goods, rendering of services, and letting off your fixed asset so that you could earn interest or royalty or dividend. So this all is covered under this standard. So I will just cover this standard in 1 minute only, considering the paucity of time. That the important criteria to measure the revenue and to record in the books is that it should flow into the business, and the cost associated to earn the revenue is easily identifiable. So one is the revenue should, it is probable that revenue should flow. Then it says that the effective control of asset has been given, which you have sold, that is been given. So you do not have any more right to exercise ownership on that, or to get the benefit out of the asset you sold or the goods you sold, right? And it is probable that you will get the revenue out of sales, and you can measure the cost. So similar way we can apply the rule on services and other third head, interest and royalties. So important is cost and revenue both are easily identifiable and measurable, and the revenue is probable to fall or to come to the business. So this is all for today. I hope you were able to gather. You are welcome for any question you may have. So this was a very important topic. You may not find many books even on this topic. So it's a hard preparation from my side. You are welcome to question even on the online portal as well. Thank you.
With this note, thank you ma'am, thank you so very much. And dear friends, yes, you can ask your questions, and you can contact us through info.cec@nic.in. You can post your questions there, and yes, we will try to give answers to your questions when next time Dr. Amarjeet Kaur visits our studio. Till then, dear friends, keep watching the lectures on YouTube and sharing your thoughts with us. We will be meeting again soon. Till then, take care. Goodbye. Thank you ma'am, thank you so much.
Thank you, Geetika.